Hey folks, Rachana Ranade here and I welcome you all to the very first video of 2023. क्या बात है? Animation team is even very much excited for 2023 it seems. So happy new year to everyone, and today's video is in today's video what are we going to discuss about? We are going to try and understand about the thought process of FIIs. If you know, since the beginning of 2021 till date, FIIs have sold stocks worth almost 4 trillion rupees. Now, we are going to understand what has been the scenario before this 2021 sell off and what is their position as on date. Okay, so we are going to compare before and after. Okay, we are going to try and analyze the sectoral allocation of FIS. So we are going to compare how much is the allocation for Nifty 500 versus any specific sector, and we are going to try and understand how much they are overweight or underweight. Not only that, post analyzing the sector, we are going to try and understand which two stocks could be possibly good ones for 2023. So as discussed, first let's understand the data points till the beginning of 2021 and then we will shift to the 2022 data. So have a look at this chart. This is the data for as on March 2021, right? So this is only a quarterly data, okay? So quarter ended March 2021. Here if you see, first we talk about the sector weightage in Nifty 500, okay? Now if we see our highest weightage is to whom? Financials, second highest is IT, and third highest is materials. Okay, this is what sector weightage in Nifty 500. Now we are going to compare that with FII shareholding in Nifty 500. So basically, if they are going above that, that means they are overweight in that sector. If they are going below the Nifty 500 weightage, it means that they are underweight on that specific sector. As simple as that. So going back to the financials one, as per Nifty 500, what was the sector weight? 31.9. But FII said we want to invest more in the financial space, and that is why they are overweight. They have given an allocation of 39.5% to financials. Okay, this is clear cut overweight. Now just to give you another example of overweight, may not be to such a great extent, one more example of that could be utilities. Here you can see from 3.3%, which is a Nifty 500 weight, they have given an overweight by of 3.7%. But all other sectors, you can see barely 1% overweight or something like that. But financials is clearly an outperformer here, right? Overweight here is almost by 7%, right? Now if I were to understand what is the scenario for 2022 here, okay, if you see here in 2022, now the weightage for financials, again sector weightage of Nifty 500 itself is 29%. But how about the case with FIIs? FIIs have still given overweight to financials, and right now it is at 34.6%. Again, right now means I had the data point till June 2022. So this is like Q1 of FY23. But still you can see here, even though if I'm comparing it with other sectors, be it energy, again understood, energy is also overweight, but by how much? By hardly 1.5%. Again, if I talk about utilities, I can see here, oh, they are increasing in utilities a little bit more. As compared to 21 data, they have increased the overweight in utilities, but still, by how much? By 1.3%. But again, clear-cut outperformer is what? Is financial space. So now we have to understand why they feel that financials could outperform, or why are they overweight in the financials. That's what we are going to understand in the immediate next section of the video. Now let's try and understand as to why financials could have been one of the favorites of FIIs. To understand the logic behind it, let's try and use some interesting analogy for that. Okay, have a look at this. And I'm sure you might be like, Ata, hey, let me explain one by one. Okay, assume that here we have RBI. And RBI, of course, as everyone understands, is the one who decides how much inflation is to be there in the economy, and they do that with the help of their monetary policies. Okay. Now, if they bring in more money supply into the economy, that is called as the quantitative easing, what is going to happen because of that? That will lead to overall increase in the interest rates, correct? As interest rates keep on rising, we say yields will go rising for bonds, and as yields rise, bond prices are going to fall. So always remember, there's going to be an inverse relationship like this seesaw for yields and bonds. And with this, banks could have M2M losses for the bonds that they might have bought earlier. But on the contrary, what would happen? On the contrary, if inflation peaks, and at one point in time, if RBI now wants to focus on easing out interest rates, because of which now the interest rates are going to shrink, the bond yields are going to shrink, and the seesaw relationship is going to maintain, inverse relationship will be maintained, because of which bond prices will rise. Now that bond prices have risen, that is going to have a nice impact on the bank, because banks are now going to have increased profitability because of basically the M2M profits. What is M2M? Mark to market profits. With this, what will happen? Their EPS will increase. Now, have a look at this. If EPS increases, what is going to happen? If I'm talking about the various parameters for valuation, something like a PE valuation, if their denominator, that is a EPS, has only increased, now automatically their valuation will look comparatively cheaper, and this is going to be positive for the bank. But this is what we discussed from the overall perspective of what FIIs are thinking. What is the thought process of RBI is also equally important. What does RBI feel? Does RBI feel that inflation is going to ease off or not? For that, have a look at this chart. Now, here you can see that since 2020 till almost 2022 beginning, you can see that inflation was continuously on the rise. But RBI has also forecasted, by the way, this is about RBI's forecast. They have forecasted that yes, inflation seems to be at peak, and now they feel that inflation might go down and down. You can see that peak point happened somewhere around Q1 FY23 at 7.5%, and since then you can see here it is going down and down and down. And if you see the red dotted line, which is about the RBI's projection, somewhere around Q1 FY24 they are expecting the inflation to cool off at around 5%. Now, have we understood about the stance of FIIs? Yes. Have we understood about the projections of RBI? Yes. Now what? I hope you have understood which sector is going to be in focus today, and that is going to be banks and financial institutions. And the name of the stock is Karnataka Bank Limited. So before we move on to the analysis of this bank, let me first of all warn you that this is a small cap. Its market capitalization is barely 4,780 crores. So the moment we are saying that it's a small cap, it means that it comes with a high risk category. And if I'm talking about a high risk, there are also potential high returns. But could that be possible? For that, let's have a look at some basic pointers of Karnataka Bank. First of all, you need to know that this is a bank which has a good banking experience of over 9 decades. It has a network of almost 877 branches. It's spread across 22 states and 2 union territories. If I have a look at the financial highlights of this bank, have a look at this. The total net advances for this bank has been increasing continuously. Whatever you can see are rupees in crores, by the way. It has been increasing. So is the case with net profit. That is also in an increasing trend. If you have a look at the deposits, that these are also increasing. If you have a look at CASA, now what is CASA? Current account, saving account. That is also increasing. See, if that increases, again, the cost of funding for the bank is going to go down, which will help to push up the profitability further. And if you have a look at the NIM is what? Net interest margins. They are also on a rise. It was at 3.18%, got cooled off a little bit, but it has already reached the same level in financial year 2022. Now, all these points look good to me, but if I were to come to a very crucial point in the banking sector, what is that? That is about NPAs, right? So for that, have a look at this. If you see gross NPAs are at 3.9%, and if you see that has been on a decreasing trend. NPA is always, it's lower the better. So that is on a decreasing trend. And even if you check the net NPAs, that is also at the lowest right now if I were to compare 2018 onwards. So that is also decreasing. But is 2.42 in itself a comparatively bigger number? Is there any other number that we should look at? We are going to discuss about that. But before that, let me complete two more ratios as well. If you see here, return on assets has shot up in the last quarter of Q2 FY23 to 1.10%, and even ROE has shot up to 14.36%. That's again that sharp rise is in the Q2 FY23. What does this mean? Returns are increasing, that is maybe the bottom line is increasing, and for that we also have to try and understand the relationship between how profitability can increase versus what is the scenario with their bad debts, that is the NPAs, non performing assets. Now for that we were trying to look into the management commentary. Mr. Mahabaleshwara, he has mentioned in his management commentary, I'm just going to focus on the key points. He says that we are increasing the provisions and the PCR if you look at the various segments. We have not yet looked at the various segments, but what is he saying? We are increasing the provisions and we are increasing the PCR. Here he is saying very clearly that we have already increased the PCR to around 80%. Provision coverage ratio is already at 80%. And in the line below that, he is saying that we are able to sustain, we feel that we should be able to sustain this PCR at around 80%. So, okay, I'm comfortable with the fact that PCR is at 80%. What about the provisions? Here you can see 90, what about the overall coverage? I mean, 93% security coverage is there for our NPA portfolio is what he says. Now, for those who did not understand even 1% of this entire management commentary, let me try and simplify this for you. Okay, what is he saying? 93% security coverage is there for our NPAs. Means what? Assume that they had given a loan of 100 rupees. Okay, and it went bad. For that, they have an asset backing of 93 rupees. Correct? So for every 100 rupees loan, they can easily recover 93 rupees because that is the backing that they have. That is what is the security coverage that they have. Now, the problem is about that 7 rupees effectively. That is like lost money for them. That is exactly what that is what exactly PCR caters to. Are they able to have good provisions for that, for this 7 rupees, which is actually going to go bust? Okay. So, for that, what are they saying? They have PCR around 80%. But wait, 80% is not of 7 rupees. 80% is of 100 rupees of loan given. So now you can imagine, for every 100 rupees of loan given, they have 93 rupees ka security, plus they have 80% ka PCR, 80% of not 7, 80% of entire 100. So that takes the entire provisioning scenario plus security scenario to 170% plus. So for every 100 rupees loan given, they have a security of almost 170. Does that sound good? Does that sound comfortable? Obviously, yes. Now, for that, we have to also understand about one more chart as to where is the exposure, to which sectors is there an exposure, and how much is secured loan and how much is unsecured. For that, have a look at this chart. If you see overall, worst case scenario is with NBFCs where secured is almost zero, but best case scenario is with large enterprises where secured portfolio is almost 100%. But have a look at the green line in a horizontal direction. You can see that overall secured is around 90%. Just one dip again in the other segment where it is a shade below 80%, right? So 93% that we were talking about in the management commentary can also be seen in this specific line as well. How about the PCR? PCR, you can see those purple lines. PCR is almost 100% for NBFC. Even if you see large enterprises, infra or others, it is as high as almost 100%. But let's have a look at the average figures also. If you have a look at agri, MSME, housing and whatnot, the overall 60% criteria seems to be the overall scenario. What is the scenario all in all? Okay, majority cases, they loans are secured to 90% plus is one scenario. Now we looked at all the sectors also. Number two, even if we talked about PCR, average was 60%, okay, but 60% is still good. Why? Out of 100, 90 is secured, and again on 100 they are doing a provisioning of almost 60% plus. So am I comfortable? Answer is yes. One more point we'll look at, even if you are talking about the NPA scenario, we'll see where does the NPA come from. For that, have a look at this pie chart. You can see that up in the retail segment, the NPA is having a major, in overall NPA, retail has a major chunk of almost 75%. Now, what do we mean by retail loans? They have said that retail is where we are giving a loan up to 7.5 crores. Okay. Mid corporates is almost 25%, large corporates is hardly any chunk. Now, just as overall my experience says, is that it's not that difficult to recover money from retail individual investors. So recoverability can be good. On top of that, they have security. On top of that, they have good provisioning. And with that, once money is being recovered, can I say provisions will be written back? Or with more and more money flowing in, can I say that profitability is going to increase? Answer is obviously yes. If that be so, are FIIs increasing the stake in these companies or not? For that, have a look at this. September 2020, FII's holding in Karnataka Bank was 7.33%. September 21, they increased it to 9.1%. And any guesses for September 2022? They have increased their shareholding to 18.15%. It's almost double in 1 year. So if they are so much bullish, I hope by now you have understood the overall logic of they increasing their stake in Karnataka Bank. I want you all to tell me in the comment section what are your thoughts about Karnataka Bank. What is one positive point, one negative point that you feel about Karnataka Bank? Now let's go on with the second bank. As I mentioned, one bank we took from the public sector space. Now we are going to talk about a bank which is from the private sector space, and the name of the bank is Federal Bank Limited. Let's understand some basic points about this bank. It's an Indian private sector bank headquartered in Kochi, that is in Kerala. If we have a look at some basic data points for this bank, you can see here that their gross NPA has always been below the industry average, and right now it's almost at the lowest point at 2.8%. Even if you have a look at their NPA chart, here you can also see that here again they are below the industry average, and latest data point it is at the lowest at 0.96%. Now, if we have a look at their overall business growth, you can see here that the advances are also increasing, their deposits are also increasing. But one interesting point here is that their percentage share in the advances market has been at the highest point right now at 1.21%. I know 1.21% in a figure itself is not big at all, but for the bank to move up from 1.06% in FY18 to 1.21% in FY22 is encouraging, right? If we move on to the PCR numbers now, you can see here that their PCR has been again increasing constantly from 43.47% in FY18 to 65.54% in FY22. Also would want to tell you that as per the latest quarterly data available, that is Q2 FY23, their PCR has further gone up to 67%. Now if we have a look at the net interest margins, you can see here that NIMs were at peak at 3.21% in FY18. They started to cool off, and in FY22 it has almost regained the point of 3.2, but 3.20 round off. But there is an important update here. As per the latest quarterly data available, Q2 FY23, their net interest margin has climbed up to 3.3%. Okay. Moving ahead with CASA, again you can see that CASA has been increasing from 33%. Took a dip, but now is back to the highest point. It is at 36.94% right now. If we have a look at some of the ratios about their returns, return on assets is at the highest point right now at 1.21%. Return on equity is also at the highest point right now at 14.36%. Now, if we have with all these basic points right now, if we have a look at the valuations, if I were to compare it with other private sector banks, of course, ideally I should not be comparing it with something like an HDFC, which has a price to book value of 3.60, nor with an ICICI with a P2BV of 3.46, because they are very big as compared to a federal bank. But even if I talk about some mid size or small size, have a look at this. Kotak is at 3.70, Axis is at 2.40, both are still bigger ones. IndusInd at 1.99. Yes Bank is also at 1.66, but Federal Bank is available at 1.53 right now. So the point that I was trying to tell you, that we are focusing here on those banks which are comparatively undervalued, and that is why I thought of showing this number to you. Going on to the last point right now, if you have a look at the shareholding pattern of FIIs, you can see here that FII shareholding used to be in the 30s in late 19 or early 20s, it dipped a little bit. December 2020, here you can see it went down to 21.69%. But from there, the FIIs have started to increase their share, and right now it is at 26.40%. All in all, even if you search for yourself since 2018 till date, the FII's percentage holding has never dropped below 20%, and this figure of 26.40 in itself quite a big number. Well, I hope you understood and enjoyed the fundamental analysis of both these stocks. But if you want to know more about the technical analysis of these two stocks, don't forget to check out our website. Just click on the blog section, and that's where you'll find the technical analysis of both these stocks. If you found value in this video, don't forget to share this with your friends. And if you want to know more about one stock for the next decade, you can click here. And if you have not yet subscribed to the channel, don't forget to click here. Till then, take care. Jai Hind and bye bye.